In this video, we're going to continue our discussion of game theory by talking about sequential games. This is out of chapter 14 material, and we're going to continue our discussion by talking about sequential games. Now, sequential games are different games than the ones that we worked in class. So let's go ahead and talk about sequential games. Sequential games are games of alternating moves, where we have a leader and a follower. Right? Alternating moves means one firm moves first and may have an advantage by doing so. We often think about leader advantages or the first mover advantage when we think about companies that have dominated industries for years. Okay, so we think about Intel, for instance, in the making of CPU chips. So Intel started in the 70s. They were the first producer of these chips, and they kind of cornered the market on a lot of the good engineers that were graduating from engineering schools. And so they gained an advantage that way. We think about Boeing, for instance, in airplanes. We think about Hewlett-Packard in printers. Okay, these companies generated a large market share partly by being first in the market. So what are some of the gains that large first movers can generate for themselves? All right, the gains come from learning curves, in some cases where the product is rather high technology. The first mover in the market can get down the learning curves more quickly, meaning they can lower their costs of production by learning how more efficiently to make the product. So the more chips that Intel makes, the lower is the average cost of making additional chips. So that means that because they're in the market first, they have that advantage over late rivals. It could be that a company that is in first develops brand loyalty. This is particularly true in industries like pharmaceuticals, where people might find that there's a high risk of trying alternative brands of a particular drug. So when a patent runs out on a drug after 20 years, we might find that that patent holder continues to have a large market share, even when prices are sometimes double the prices of rival brands. And the reason for that is because there's a high risk of trying a different kind of drug or a different brand of drug. So learning curves, brand loyalty, these are a couple of reasons firms might have a first mover advantage. It's not always the case that firms have first mover advantage. It could be that there's a second mover advantage. In the case where you have a large company that is trying to figure out whether to invest in research and development for a new product, or simply wait until another smaller firm develops the product, and then that larger firm often buys out the smaller firm, or re-engineers the product and then sells it under their own label, and it turns out to be maybe a slightly better product, or a product for which there's simply more brand loyalty because of the name recognition of the larger firm. So these are all issues revolving around sequential games. All right, now we can take a look at an example really quickly from the business press. Here we have an iron ore set of companies that are expanding even though prices are retreating. So this was a few years ago, but it's a good article to kind of get you thinking about this. I'm going to post this article in tracks. I only have the first few paragraphs here. It says, iron ore prices are plummeting and demand is easing, but miners are digging up more and more iron ore. All right, so the discussion here revolves around these companies expanding production even though demand is falling a bit. And partly they're betting that their efficiencies of scale, economies of scale, will allow them to profit even though prices are a bit lower. And game theory comes into play because it could force high-cost competitors out of the market. giving them more pricing power in the long run. So first movers have the potential benefit of squeezing out smaller rivals as well. All right, well, let's move to an example of the first mover advantage. And I'm going to start with a game of entry deterrence. It could be that a large firm finds that if it expands its scope of operations, if it builds more locations, if it grabs more market share, it might be that rival companies simply don't find it profitable to enter. All right, so let's take a look at an example here where we have two grocery stores, one a rather large company, King Foods, and then a smaller company, Fresh Foods. We'll denote King Foods as KF, Fresh Foods as FF. And our goal here is to figure out whether or not King Foods can do something to deter entry. All right, so what we're going to do is we're going to set up profits and scenarios. So let's suppose King Foods can either build one or two stores in a new town. One or two stores. And then if they remain a monopoly, then that means that under a one-store presence, they have $15,000 of profit. Under two stores, profit is less. Profit is only $10,000. Now, profit is less here with two stores, perhaps because the fixed cost investment in two stores might be significant relative to the increased demand from consumers, right? The benefit is that you're a little bit closer to all consumers, but demand won't jump up by the amount that fixed costs jump up, so usually profit's a little bit lower. And then we have a duopoly situation. Now, duopoly, again, is a special kind of oligopoly with two firms. So this is assuming King Foods, KF, and Fresh Foods, FF, are both competing. We have profits of $6,000 for King Foods and $4,000 for Fresh Foods under one store by King Foods. Now, we assume if Fresh Foods enters, they're just going to enter with one store. They don't have the ability to enter on a large scale. Finally, if King Foods builds two stores and there's a duopoly with entry, then the profits are a little bit lower for both firms, $4,000 and $2,000. Let's also suppose there is a fixed entry cost for Fresh Foods. So Fresh Foods has a fixed entry cost of $3,000. So that's going to be subtracted from the profits that we see up here for Fresh Foods. So we assume this is kind of the cost of perhaps starting new advertising or something that Fresh Foods has to expend that perhaps King Foods doesn't have to expend because of their size or presence or the knowledge that people have of them. All right. So let's go ahead and build a game tree that shows the decision paths that each firm has. And so we're going to start with King Foods on the left. We have a system of nodes and connectors. So King Foods can either choose to build one store, that would be the upper path, or two stores, the lower path. And then after that decision is made, Fresh Foods can choose between entering and not entering. So we call these a system of nodes and connectors. So enter or not enter. We're just going to transpose now from the table the profits that we had earlier. Okay, so the profits here, and we're going to list King Foods first and then Fresh Foods second. The profits are in thousands, 6,000 and 1,000. Now remember that there was a fixed entry cost of 3,000. So when we calculate the fresh food profits in this case, we're going to be taking 4. That would be the duopoly profits for Fresh Foods, and then subtract 3, which gives us 1. And we're going to do that for all of them here, and so the rest of the payoffs are 15,000 and 0 when King Foods is a monopolist with 1 store. That's the best outcome for King Foods. 2 stores and enter is the 4 and -1, and then we have the second best outcome for King Foods, and that would be 2 stores and not enter. Now we solve these games using backward induction. Backward induction means that we're going to start at the end and work back to the beginning. So we use the backward induction to find the Nash equilibrium. So we begin at the end and we say if Fresh Foods, if I label these nodes 1, 2, 3, if Fresh Foods is at node 2, what would they decide to do? King Foods is already committed to 1 store, so Fresh Foods would enter because 1 is bigger than 0. If Fresh Foods finds themselves at node 3, King Foods is already committed to 2 stores, then Fresh Foods would not enter because 0 is better than -1. And then once we have these paths by Fresh Foods at nodes 2 and 3, we can say, what would King Foods now do at node 1, knowing full well how their rival is going to react at the other 2 nodes? Well, now King Foods says, I can clearly see the path. I would earn 10 if I build 2 stores, or 6 if I build 1 store. So I'm going to build 2 stores, and the Nash equilibrium is 2 stores and not enter. We're going to follow or describe the path that's taken. So King Foods is first, Fresh Foods is second. Now let's suppose that the fixed cost of entry by Fresh Foods is less than 2,000. Then we have a change, don't we? If the fixed cost fixed entry costs are less than 2,000 for Fresh Foods, then we have a different outcome because this -1 turns into something positive. And now the choice is for Fresh Foods at node 3 to go ahead and enter, which also means that King Foods at node 1 will choose only 1 store. So 1 store and enter would be the Nash equilibrium. So it depends, this incentive or this ability, I guess, to deter entry would depend upon the size of that fixed entry cost, right? And so here we find that King Foods can deter entry when fixed entry costs are greater than 3,000. We also know, of course, that Fresh Foods could move first in this whole scenario and completely turn the tables. And we'll discuss that a little bit in the next slide.